Hello, I'm Ben from Modern Graham, and today we are going to do a Modern Graham valuation of Archer Daniels Midland. So let's get started. The current price is $59.31. The sector is consumer defensive and industry consumer packaged goods. Now, these are the things from the balance sheet that I find most important for the Modern Graham valuation. And we've got total current assets, total current liabilities, total long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. All of those figures will come into play in the analysis here. Then let's talk about earnings. So if we come down here, we can see the historical earnings per share. And you can see first we have a column that is the earnings per share diluted, and then we have the earnings per share MG, which is what I call the Modern Graham earnings per share. It is a weighted 5-year average of the last 5 years of earnings. So this one here, 587, takes into account all of these, putting the most weight on the current fiscal year and the least weight on 5 years before, and that's why we get 587. That smooths out the business curve a little bit and allows you to really see more of the trends in the earnings. Here we have the dividends, and you can see there has been long-term dividend growth in this company. That's always great to see. A good, strong dividend yield and a good dividend payout ratio. I would like to see it be a little bit more consistent, although, again, that shows that even though earnings are moving, they are focused on growing that dividend. If you look at the chart here, you can clearly see that earnings per share diluted has kind of bounced up and down a bit, but that dividend rate or the dividend per share has continued to grow. This is a great dividend growth company. Now, stage one, we want to determine, is this company suitable for the defensive investor or the enterprising investor? And remember, the defensive investor is one who is not willing to do as much research into a company. And so they have more stringent requirements because they want that top level to be really strong on the balance sheet and on the financial statements. So they have to pass 6 out of the following 7 tests. First of all, the company has to be big enough. Here, the current market cap is well over $2 billion, so it passes that test. Then the company has to have a strong financial condition as shown by the current ratio. Here, it is only 1.44, so we fail the defensive test here for current ratio. But let's see if it can pass the rest. Earnings stability. It has positive earnings per share for 10 years. Yes. Okay, we passed that. Dividends. We have dividend payments for 10 straight years, so we passed that. Earnings growth. An increase of 33% in earnings from the past 10 years using 3-year averages. At the beginning and the end, we have over 33% there, so we pass. A PEMG, that's the price over that earnings per share Modern Graham figure. We want that to be under 20. It's 10, so it passes there. And the price-to-book ratio under 2.5, or the price-to-book times the PEMG under 50. So here the price-to-book is under 2.5, so it doesn't even matter that the other part is as well. So it does pass 6 of the 7 for defensive investors, and it would be suitable for that investor type. Then let's just look at the enterprising investor. It automatically qualifies for the enterprising investor because it meets that for the defensive, but we'll look at these anyway. Again, the current ratio isn't quite strong enough for even the enterprising investor, but it makes up for that because the debt is pretty low at a debt to net current asset ratio of only 1. And then the positive earnings per share for 5 years, it currently pays a dividend, and the earnings are greater than they were 5 years ago. So we pass that. Stage 2 is to determine the intrinsic value, and here we use Benjamin Graham's formula from The Intelligent Investor. And so that is value equals earnings per share times 8.5 plus 2 times the growth rate. And again, we calculate the earnings per share, have a weighted average to get that nice and smoothed out. And then we take that and we use that to estimate the growth. We take that from 5 years previously, and the current one, we get a total growth of 105%. We divide that by 5. We get a total average growth of 21%. And then we like to have a safety margin here. So the safety margins are key for like making sure that you're not that you're being conservative in your valuation. And the growth figure is such a key variable in this formula that we want to make sure that safety margin is here. And then not only that, but we cap it at 15% because this is supposed to be a like perpetual or a long-term growth figure. And it doesn't seem reasonable that any company would be able to grow more than 15% for a very long time. So that gets capped there. And then plugging those figures into the formula, we get a modern gram valuation of $226. And as you can see, that is considerably more than the price. So over here, you can see the modern gram opinion, and that means that it is significantly undervalued. Coming down here, we can see the modern gram grade. It gets 2 points for being suitable for the defensive investor. It is a undervalued company, so it gets 1 point. It gets a point for trading below its gram number, which we'll talk about that in a moment. It gets 1 point for having long-term dividend growth. It gets half a point for being a dividend yield above 2%, and another half a point for being below its industry average PEMG for a total of 6 points, which, as you can see here, that makes it an A+ grade. It is one of the best looking companies in the modern gram but what's the word I'm looking for? Modern gram universe. There we go. And stage 3 is further research. So once you've determined that the company is suitable for your investor type and that it is undervalued, the next thing you need to do is do a little bit further research to determine if it is the right company for your individual portfolio. And some things you might consider are like the net current asset value. That would be a liquidation value. And here it is not applicable because the NCAV is negative. But the gram number, again, this is another thing that people might look at to help kind of visualize whether a company is undervalued or quantify that. And this is taken from some of Graham's requirements for the defensive investors. Somebody at some point turned it into a formula, and so we get the gram number of 7432. And again, it's trading below that, so that is pretty key. And then the PEMG is 10.10. And looking over here, we've got a little bit more useful information. Dividend yield is 3.3%. It has 48 consecutive years of dividend growth, and overall, it looks good. And if you have found this valuation to be interesting and useful to you, be sure to check out my Patreon. You can find the link to that down below. But thanks for watching. Be sure to click on the video on the screen now. It will take you to another valuation. And I will catch you next time. Take care.